Unlock the secrets from a seasoned investment strategist with over 45 years of experience, who also mentored some of the most influential investors of our time. How do institutional investors truly outperform retail? What can recent market cycles teach us about spotting bubbles before they burst? And how might upcoming Federal Reserve leadership navigate one of the most complex macro environments in history? In this episode of Main Street Meets Wall Street, George Haupthfuhrer shares his unique perspective gained from decades of navigating market highs, crashes, and everything in between. You'll discover how institutional investors access exclusive alternative assets, think long-term amid short-term noise, and rebalance intelligently to avoid common pitfalls. Volatile markets like last year's dip in the tech-driven rally. We break down the difference in information accessibility between professionals and retail investors, revealing why knowledge is power in building resilient portfolios. George also dives into the historical patterns that warn of cycles and bubbles from the dot-com crash to the 1987 market meltdown, and how to interpret these signals today that may suggest whether we're in a prolonged expansion or a bubble on the brink. His insights and AI's impact on markets, the influence of politics and fiscal policies, and the future of Fed leadership, specifically to the potential of Kevin Warsh, are essential for investors wanting to stay ahead of the curve. This masterclass is understanding market psychology, navigating macro risks, and seizing opportunities in an unpredictable landscape. Whether you're a seasoned investor, financial advisor, or just getting started, you'll leave with concrete strategies to manage risks, harness opportunities, and think like the pros. If you want actionable insights from a veteran who's seen the cycles and knows how to adapt, this episode is your must listen. Prepare to rethink your investment assumptions, decode market signals, and position yourself for long-term success, regardless of what the next chapter holds. George is a highly respected investment strategist and CFA charter holder with leadership expertise at firms like Invesco and Prime Bolsa. Known for mentoring his next generation of financial advisors, his deep insight into market cycles, asset diversification, and macroeconomic trends makes this episode a goldmine for anyone serious about investing in today's and tomorrow's market. Perfect for investors, financial professionals, and anyone eager to understand the mechanics of markets in a rapidly changing world. Don't miss this chance to learn from a true industry veteran. Hit play now. Welcome back to the Main Street Meets Wall Street podcast. I'm your host, Marcus Sturman Sr. Today's guest is a colleague who perfectly embodies our mission. He's a CFA charter holder, a leader within the CFA Society of Atlanta, and a seasoned investment strategist with a career spanning firms like Invesco and Prime Bolsa. He's a dedicated mentor to the generation of financial advisors coming into this world. Without further ado, I'd like to introduce you to Mr. George Haupthfuhrer. Hello, Mr. George. Welcome to the show.
Marcus, it's great to be with you. I appreciate the invitation to do this.
Yes, thanks for having you on. We have a lot going on in the world today, so I'm not sure if you had a chance to check out the podcast. What we like to do here is we like to take a little bit, just talk about current events, and then we'll speak about a little bit about your history and where you've come from, you've seen a lot of this stuff before. So we would love to catch some of your knowledge and wisdom in that perspective. Just look for a wide range conversation. So I guess people always say that history rhymes, but history doesn't repeat itself, or maybe history repeats itself, but history doesn't rhyme. What's your perspective on it, and what does today's environment looks like to you compared to historical times?
That's a great question. Certainly, there are things that we should be able to learn from the past, but I think every situation is a little bit different. And today, that war in Iran is a factor that we haven't really seen anything similar in my lifetime, although we have had previous Gulf wars. I think the other thing that's a little bit different today is the fact that we're about to get a new Fed chair, and we don't know exactly, what his point of view will be, with perhaps a bias toward trying to reduce the Fed funds rate, short-term rates, but with inflation still above 2%, really closer to 3% today, there's not too much I think the Fed could or should do in lowering rates near term. So I wouldn't be surprised if the market just treads water for a while now. Earnings seem to be pretty good. That's always a key factor as well. I think one thing that I've hopefully learned in my career is to try to remove the emotion from the investment decision. In the final analysis, corporate stock prices are a function of earnings and earnings growth, and then whatever PE multiple you put on those earnings. As I mentioned earlier, earnings have been coming through pretty solid. That could change if the war in Iran lasts longer than most people expect, and if oil prices go from the current $100 per barrel range up to 120, 130, 140. We could possibly be facing a recession, not just in this country, but in a lot of the G7 and other countries that we trade with. So that's a wild card. And to me, another lesson I hopefully have learned in my long career is the importance of being diversified, not putting too many eggs in one basket. And so whether you're talking about stocks, where I think it's important to have a non-US allocation as well as your US allocation, but also within the US, have your large cap, your mid cap and small cap, but also have a good style balance between growth and value. And when you see one area of the market significantly outdoing the other, I think a good discipline is to trim back your winners. In this case, mega cap growth names have really dominated the U.S. market for most of the last 5 or 6 years. And so I just think it's prudent to trim and take some of those gains and rebalance into small, mid-cap, value-oriented names. My comments apply more to institutional investors, where you don't have to pay a tax on capital gains. When you're thinking about retail or individual investors, where you do have to pay a tax and then you're reinvesting 75 cents on the dollar, that can be a different issue, because you have to be even more convinced that whatever you're trimming is not likely to continue to do so well, outperforming the rest of the market, and whatever you reallocate those funds into is likely to do better. So it's really a twofold decision when you make that kind of rebalance as a retail or individual investor.
Yeah, that's a great breakdown. People tend to forget about taxes when they're investing, or even when they're preparing for retirement. They'll have a lot of their money in pre-tax accounts, and they'll retire and they'll pay Uncle Sam. They'll take out $100,000, give Uncle Sam 40,000 of it or something. They're really upset of it when Uncle Sam's really happy that you just retired. So you were mentioning your strategy, a good approach with the diversification, and you actually were mentioning the barbell strategy, whereas if you see growth start to get too heavy, maybe you move a little bit heavier to value inside your investment strategy. Inside of that, you mentioned that you were referring to institutional investors. That's the level you worked at before. Can you go a little bit deeper into that as to like some of the differences because people always see institutional investors as having the advantage, but there's a lot of information now for retail investors. What kind of information or what kind of advantages would you say institutional investors have that retail investors don't have?
Well, number one, institutional investors can access alternative assets like private equity, private real estate, private credit, and hedge funds, direct hedge funds, as well as fund of funds, in a way that most retail investors are unable to do, although there is now an increasing number of what we call evergreen funds that have lower minimums that retail investors can go into. The firm that I've just retired from, Prime Buckholz, does not currently recommend any of those, but I know the research department is looking into that as a possible solution. So the first thing would be the breadth of assets that you can tap into as an institutional investor, especially those where the minimum could be as much as $5 million. Always at Prime Buckholz, we had plenty of accounts that were, 100, 200, 300 million or so. And so it was not too difficult to allocate 5 million to meet a particular alternative asset manager's minimum. The second thing that I think institutional investors are able to do, which most retail investors find more challenging, is take a really long-term strategic view, and be able to ride out the inevitable ups and downs in the stock market. I think retail investors tend to be a little more influenced by short-term swings, and they're more emotional in making their investment decisions. If something goes down sharply, say 20%, they might be more inclined to sell it, whereas an institutional investor might add to it. If they liked it at 100 and it's now selling for 80, why wouldn't they like it better if the fundamentals are still intact? That's a big if. But I do think institutional investors think longer term. They're not likely to be tactical the way some retail investors may be inclined to be.
Gotcha. Yeah. So the mindset, first of all, like you said, that just the different types of investments you have access to. The mindset is very important as well. So when you mention like the dips of 20%, we actually saw that last year when we saw the market go down 20%. So I don't know. I'm not sure how much institutional investors bought back into that dip. I know retail investors purchased a lot of that dip last year. That's why I was saying it seems like there seems to be a shift inside of the institutional versus retail investor mindset. Would you, do you think the democratization of information has made the retail investor, like, do you think retail investors have the exact same information now as institutional investors? I know like back in the day, people could go out and count like, cars in parking lot, like those type of things that retail investors weren't doing, but institutions were doing. Like, what do you think that the information level is now?
Yeah, I think the difference in terms of information has really narrowed over my career, which goes back actually 45 years. So it's a more level playing field now. And I think institutional investors, just given the resources that they can bring to the analytical process, still have an advantage. But I think retail investors have narrowed that advantage by what's available, online and through other sources. I will say that there's another important distinction in the investment world that might be worth making, and that is momentum investing versus what I might call contrarian investing. And, momentum investors, if the stock goes up, they may buy more of it. They're going to think that will stay in motion positively. Whereas a contrarian investor, in the example that I gave a couple minutes ago, if the stock goes down and the fundamentals have not changed in any material way, in other words, key personnel at the company and positions in their market, haven't changed, that makes it a more attractive stock. So you have those two schools of thought, and I think it's a challenging balancing act for most investors. So you don't want to be always playing the momentum game or always being a contrarian. You can get burned either way. As a contrarian, for example, and I had this happen to me once or twice when I was at Invesco, and we had a discipline of adding to losers if we thought the fundamentals were still intact. And, a stock that goes down 20, 25% can go lower. It's like trying to catch a falling knife. You can be burned or cut in this analogy by thinking something is likely to rebound and then it doesn't. So it goes back to what I said about being well diversified. When I was at Invesco, our average client portfolio had 50 names in it. And each position was in the neighborhood of 2%. Some might have been 1, some might have been 3, 3.5. But in general, we wouldn't have any position be 6, 7% or so. And I think the average investor today probably doesn't realize that if they own the S&P 500 index, they've got 7% in NVIDIA as one stock, and then they've got a pretty large percentage in Microsoft and Apple and other mega cap stocks. You can buy the equal weighted S&P. I think my old employer Invesco offers that, among others. And that way, if there's a rotation and the smaller and mid cap stocks do better, you'll do better in the equal weighted S&P as compared to the traditional cap weighted S&P. But I think that's enough on that particular tangent for now.
Yeah, and the Invesco fund you're talking about, the RSP, the equal weight has actually been outperforming this year until it recently started to change. And yeah, people don't realize the amount of concentration inside their portfolios. You've been doing this for 45 years. So like 1981, right at the beginning of the 80s. So you've seen different type of markets. You've seen how hot the market ran in the 80s, and you saw how that ended, right? Like every cycle ends eventually, right? What do you look for in cycles? Because people think we're in an AI bubble. What should we be looking for as to maybe this cycle is run hot? Is what we're seeing right now a signal that this cycle's in, or is this just something in a longer rotation cycle?
Yeah, you don't really know where you are until you have the benefit of hindsight down the road. But I will say, the period at the end of the 90s, 98, 99, going into 2000, was a pretty clear bubble. So at Invesco at that time, all of the portfolio managers could pick from a purchase list, an approved list that had, 80, 85 names, and we would circulate the statistics of the client portfolios quarterly. And I realized as we were moving toward 2000 that the average capitalization of my client portfolios was a little bit lower than those of my partners managing, the same U.S. Value equity, core value. And that was because I felt like, Cisco and the other mega cap names were ahead of themselves, that the current and future earnings didn't justify the prices at that time. So I was migrating down into the mid cap space and lagging the S&P 500 as it continued to go up. It did turn in, the first quarter of 2000, and the small and mid cap did outperform for the next couple of years. So I was a bit early, but I think my inclinations were correct. And so bringing that up to 2026, it is hard to know about the impact of AI. We've already seen some of those, so-called Magnificent Seven stocks benefiting from that. And no doubt it is changing the way a lot of companies do business, I think for the better. And it's unclear, at least to me, whether that's going to result in the aggregate employees being laid off or the need for, net new hiring. Most people think it'll result in net layoffs. But I think the jury is still out on that. Time will tell. But there does tend to be a little bit of, I would call, overhype in an area such as AI. We've seen that historically in other areas. You've probably heard about the so-called tulip mania in the Netherlands, several centuries ago now. And whatever the product or commodity might be, there's usually a limited supply. And then when the demand takes off and the price takes off, you have to be really careful. I think it was probably Warren Buffett who said that when others are greedy, be careful. And, when others trash a stock, take a closer look because there could be a buying opportunity. So that goes back to what I was saying earlier about being a bit of a contrarian. And I think the part of Invesco that I was involved with for those 14 and a half years was more in that camp where we would be trimming our big winners and we might be, adding to our losers.
So y'all were in constant rebalancing, more actively managed at that time than most accounts.
Yeah. I was at Invesco just when passive management was starting to become more and more popular, primarily through firms like Vanguard that offered all these indexes at a really low fee. And today, you can get a lot of their indexes at 3 or 4 basis points. When I was at Invesco, and I don't know about today, but we would charge, I think it was 75 basis points on the first 10 million, 50 on the next 10 million, and 25 basis points above that. And if you had a really large account, you could negotiate that. But that is a headwind for active managers compared to the low-cost index funds. Now, that said, my younger son is at T. Rowe Price, which has active orientation and a great long-term record. depending on whether you want to look at, 5, 7, 10 years or what have you, at pretty reasonable expense ratios. And active managers in general will lag strong markets and then outperform in flat or down markets. So in a full cycle, you tend to have a smoother ride. And a lot of investors prefer that smoother ride rather than the more volatile ups and downs that you see through.
Got you. And like you said, so in that situation, when you have the actively managed fund, it's going to be a higher fee. You're looking for some delta inside, just maybe the way you're actually managing the fund. You're finding different accounts, different stocks. Like you say, you're contrarian view. You're going to catch stocks that are low, and then when they come back up, it's going to make up some of that change that you're not getting or for that you're charging extra fee. People will pay extra fee if you can show them that you're worth the fee. I want to pivot a little bit here, but we'll talk about Kevin Warsh. I know you're speaking about the Fed. We're entering into our situation right now. So with new Fed chairs, you've seen several of them in your life. They always seem to get tested by something. Something happens in the market when the Fed chair comes in. Right now, it looks like one big thing is going to be whether Warsh is, when he gets put into office. I'm up here in North Carolina. You're in Atlanta, so I said up here. But down Wall Street South, and Tom Tillis is holding up the process right now until he gets some more clarity on Jerome Powell. But Kevin Warsh is coming to a situation where we have global geo tensions at a really high level, oil disruption at a really high level. And then the national debt at like 100, a serviceable national debt of above $160 trillion. How can Warsh approach this? Do you think he'll approach it? And then how can like Main Street investors approach this? That's a big question.
Yeah, that is. I could go a number of different directions there. I did have the pleasure of listening to Warsh at the Atlanta Society Annual Forecast Forum, February 4, I think it was. And he did a good job. He's a veteran of the Fed and been around enough to understand all these cycles. The Fed chair, when he or she meets with the media every 7 weeks or so when they have their 2-day meetings, has essentially a bully pulpit that they can use to lecture in a nice way Congress the way they, spend, beyond our means and have that kind of annual deficit and cumulative deficit that you mentioned, which is now more than 100% of the U.S. GDP. I do worry about our kids and our grandkids, inheriting that problem because just servicing the debt is taking a bigger and bigger slice out of the budgetary pie. And so that leaves less for other important areas such as education. I do think Warsh will be approved. I understand Senator Tillis's problem with commentary about, I think it is really surprising that he presided over spending so much money on that new Fed headquarters in D.C. I think that's not a good legacy for him. But I think we should drop, whatever litigation there is at this point. And hopefully, even though he could stay on the Fed after Warsh becomes the new chair, I kind of hope he steps aside so that he's not in any way looking over the shoulder or second guessing the new chair. I think the Trump administration or any president of whatever party should allow the Fed to be truly independent. I think Trump has spoken, overly critically about the Fed. I mean, it is true that Powell was wrong saying that inflation was transitory, back in the end of 21 and going into 22, as inflation hit 7, 8, even 9%. The Fed, again, hindsight's always 2020, but the Fed should have been raising rates pretty aggressively back there in 22 so that inflation never got to be 8 or 9%. I'm not aware of the Biden administration trying to exert undue influence going into the midterm elections in 22. Maybe they did. But again, the Fed should be independent. So I am glad that they're serving, to the best of their ability. I think some of their models may be outdated, overly focused on historical data in an economy that is changing rapidly, like you were saying before, with AI. So maybe some of the dated models need to be replaced with new models. maybe they don't need quite as many PhD economists, working off the Fed. Maybe there's an opportunity to save some expense there. But again, I think independence is important.
Perfect. Yeah. And just for the record, Jerome Powell isn't a PhD economist. He's like an attorney, I think. Like the way he's trained, an attorney and a guitarist, right? Yeah. So Warsh will definitely come in with his hands full, to say the least, historically. And like you said, he was there for 2008. So he saw that whole financial crisis as well. So he's seen the playbook, and he's definitely a proponent of trying different models. He wants to try different type of models and new systems for data. And people hear this on Main Street all the time when you're referring to models. Like, which particular models are you referring to that may be time to put out the pasture?
I don't have anything in particular in mind, Marcus, but back 30 or 40 years ago, there was a term that was coined called the Laffer curve, named for Art Laffer, who served while Reagan was president, and he continues to be a contributor on Fox Business with the Kudlow show, led by Larry Kudlow, who was an advisor to Trump during his first term. That talks about the trade-off between inflation and unemployment. And I don't think what held true a number of decades ago is still as true today. But I'm sure there are better examples that I just can't think of. By the way, I did have the pleasure of meeting Jay Powell, and he was a client when I was at Prime Buckles, and he was on the board of a school in D.C. where he lived, and so report to him, and he recognized my last name, which is pretty unusual because of going to the same college as my brother, who was a pretty good basketball player.
Really? So your brother used to dunk on Jerome Powell. That's awesome.
I don't know if they had any one-on-one opportunities, but my brother was 6'7", or is 7.5", and he has bigger hands than I do. So I think he was able to dunk, although I don't know if he ever did that in a game. I'll have to ask him next time I'm talking.
Dunking wasn't quite the thing back then, but yeah, 6'7" with big hands. And your last name is Hauptfuhrer, so fewer hops, as we said offline beforehand. It's very cool correlation. Very cool story. I want to talk about the flight that we've seen. People have mentioned taxes in like New York. People are talking about increasing taxes in like states like Washington State now introducing personal income taxes. And in general, maybe not so much for the taxes, but we're down here in the Wall Street of the South now, right? Charlotte has become the second largest economic center in the world. Atlanta's starting to grow. The Southeast is just becoming the Wall Street of the South, and Texas as well is starting to grow. What do you see? Because even before the taxes were becoming an issue, this flight was already starting. Did you see anything that led to this move, or that you've seen why people would want to move down here to the South?
Well, I think the climate is preferable for a lot of people compared to the New York area. It's interesting. I don't really want to get into politics, but, New Jersey, New York, and Connecticut are very blue states. And New York City is a very blue city. And it now has a mayor that I guess is a
He says the socialists.
Exactly. So for people that are more middle of the road or to the right, maybe they feel like a purple state like North Carolina or Georgia, or a red state like Texas or Florida is more appealing, in addition to the fact, or related to, the taxes being lower in these, southeastern states.
Gotcha. Yeah. I feel like it's probably more of a, I don't want to have just conjecture here, but like more with the taxes it is with the political belief. Because I think at the end of the day, like you said, these are institutional investors. So you all know, like at the end of the day, your returns and your stocks and bonds, it doesn't matter the administration, whether it's red or blue. Like history shows that the stock market goes up and to the right pretty much throughout the history of time. So people making investments based solely on, red or blue, they're really missing out on it. They're really missing out on a lot of stuff.
You've just raised another issue there, Marcus, which is the pitfalls of market timing. Since the market does tend to go up long term, you got to be there to have that ride. So, when you have the inevitable downdrafts like we saw at the end of 2008 going into '09, or with COVID, back, at the end of the Trump first term, um, it's really a buying opportunity rather than a time to look for the exits. And so again, it's a caution for especially retail investors who might be inclined to, throw up their hands and raise more cash. For my client, when I was at Buckles, and we had that downdraft, both at the end of '08 going into '09, and again with COVID. And even a year ago, April of 2025, the tariffs were announced and the market, went down a double-digit percentage. It was an opportunity to buy more at attractive prices. And so if we didn't have a regular meeting set up with clients, we would call a special meeting to give our recommendations and move forward in that kind of rebalancing.
Nice. So y'all historically bought the dip, and your clients, you called them, educated them, which is a very important part of it, to let them know, like, hey, this is going to go up into the right. And I imagine some of your clients already knew that you were going to buy the dip. You probably didn't even have to call them because you've done it before for them. It's very, very great point. Time in the market. People trying to time the market, you're going to miss the best 8 days of the year every time trying to time the market. Just going back to, so speaking back 45 plus years, what was it like to be in the industry in 87, 88? There aren't very many people out here, like right when the market went down, like Black Monday, like when that happened.
Yeah. Yeah. Well, I had not seen such a strong downdraft before. I had some good summer jobs in the early '70s, where the market was, flat and then generally down, especially when Nixon ended up having to resign in 1974 because of the Watergate crisis. He would have been impeached, but he chose to resign, before that would have happened. And the market was really in the doldrums then. I wasn't an investor then. I was not making any money, but I remembered that time as being a good buying opportunity. And the same thing toward the end of the Carter presidency, when we had Americans taken hostage in 1979 in Iran, which is when the current regime took hold from what had been the Shah. And, we had real malaise in the U.S. and, gas prices rose and inflation rose. And I remember President Carter having a fireside chat, dressed in a sweater with the fireplace behind him, asking people to turn their thermostats down, and in the wintertime, and just do everything they could to conserve energy. I mean, that was a tough period, especially for check to paycheck and had to get gas to drive to their jobs. But I think the Reagan years were a wonderful growth period. And then, Bush 41 kind of continued that. I think the Clinton years were actually very good for the country. That was the last time that we balanced. To his credit, was able to work across the aisle with Newt Gingrich of Georgia, who was the Speaker of the House on the Republican side back then. And there was a collegiality in Congress that we really need today, that we haven't seen in a long time. But anyway, let's see, after Clinton 43, and, his presidency was marked by 9/11 early on in 2001. And, another really tough state election in 2004. So the country has been so evenly split ever since then. And the partisanship has gotten worse and worse. And I don't know what it's going to take to get people to especially Congress, to listen to one another and be willing to compromise the way they used to back in the 80s and 90s. But it's, in my opinion, something worth praying for, because I think our whole country, the morale of the country would be a lot better if we weren't so evenly split in ways that can be very divisive.
You got that right. This country is so divided right now. We're just red or blue. I think if you even look back, like you mentioned with Clinton, like historical Clinton, his politics and his views, now he'd probably be viewed as a Republican, right?
Thank you for tuning in to this insightful episode of the Main Street Meets Wall Street podcast. We hope you found the discussion with George Haupthfuhrer CFA as enlightening as we did. Remember, this is just part one of our two-part series. Our next episode, we'll dive even deeper into the strategies and insights that can help you navigate the ever-evolving financial landscape. Stay tuned for part two, where we'll continue to explore the intricacies of market cycles, investment strategies, and the future of finance. Subscribe so you don't miss out on the continuation of this engaging conversation. Until next time, keep investing wisely and stay informed. Main Street Heart meets Wall Street Smarts. Thank you for listening.